Before any pattern, any concept, you need to understand how a single candle is formed in a market. And hey, no candle is random. These little boxes that you see, they are not just someone pressing buy or sell. Whether you like it or not, every candle holds emotions of traders like fear, greed, confidence, force, compressed in a few minutes. And one rule that you should know is that for buyers to buy, there has to be sellers to sell, right? That means if you want a candy, then you're the buyer and the one who's selling you that candy is the seller. Similarly, in this market, every box is formed, let's just call them boxes for now. Every box is formed when both buyers and sellers agree at a price, regardless of its color or position or size. All right? See, all the candles has these four elements. A high area where the price went the highest for that candle, a low point where the price went the lowest for that candle, an opening point, an opening price where the trade started for that candle, and a closing point where the trade closed in that time period, right? Let me just draw one more since there are two color candles. See, the high area and the low area of both these color candles are same. These are the highs and these are the lows. What changes is the body, where it opens and where it closes, and that decides if it's going to be a bullish or a bearish candle. Okay. Now, see, there has to be a price where a candle opens, right? Where a trade starts. So let's just say for this candle, the candle opened at $10. Just to make it easy for you guys, see, these are the actual prices, right? So it opened at $10, say moved up to $15, then came back down to, let's say, $5, and then finally closed to $13. Look what happened here. The candle opened lower and closed higher. The price moved up, and that gives us a bullish candle. That gives us a bullish candle. Again, when a price opens lower and closes higher, that tells us that this is a bullish candle. Also, do not learn the candle by its color, like, oh, if it's a green candle, then it's a bullish candle. No, don't memorize it. Understand the logic. Technically, it means that in a bullish candle, buyers are more active. That means they are paying higher and higher prices for a single commodity. In this case, this pair, GBP, JPY. That means they are paying 10, 11, 12, 13, whatever it is. They're the buyers, they are paying it. But you remember our rule, right? The sellers are also present here the entire time. So if both buyers and sellers, if both are present, then how is it a bullish candle and how is the price moving up? See, this is the core part of all of this concept. The only difference that makes it a bullish candle is that in this candle, the traders who are buying are your new buyers. Like they are bringing new money. They are placing new orders in the market. And see, imagine a lot of buyers pressing buy now at the same time. That creates an aggressive move up. They are thinking, oh, I'll just buy lower and close higher and have my profit out of it. But the ones who are selling to these buyers, the ones who are selling to these buyers, they are not as aggressive. That's the only difference. These sellers are like the old traders taking their profit, or like the new traders with no strategy, no knowledge, just pressing sell and expecting the price to go down. Those are the kind of sellers that are providing sell orders to these buyers in this candle. So finally, a bull candle is formed when buyers are more urgent And the one side who's more impatient, more urgent, more aggressive moves the price. That urgency can come from greed of profit making or fear of missing out or confidence in their strategy, whatever the reason is. And why am I focusing on this rule so much is because there are traders who explain candlesticks and they say things like a bullish candle is formed when there are more buyers and less sellers. That's not true. And they explain it using basic demand and supply method. But that actually confuses the beginners because that'll make you think that in this candle, buyers are more and sellers are less, and that makes it a bullish candle. No, a trade cannot happen like that. Both sides are present in every candle. They just want different outcomes at the same price. That's the only difference. So if that is clear, let's flip it. In this candle, um, let's just say the price opened at $10, moved down to say $2, and then moved up back again to $12, and then finally came back down and closed at $5. What happened here? The price opened higher and closed lower. The price went down, and that makes it a bearish candle. A bearish candle. Again, do not learn it by color. It is bearish because the price went down, because the candle opened higher and closed lower. That's it. Technically, it means that sellers are more aggressive now. That means they are selling at prices like 10, 9, 8, 7. Whatever the market is offering at that time, they are taking it. And these sellers are known as active sellers. Active sellers, because now they are the ones who are bringing new money in the market, who are placing new orders. Again, imagine a lot of sellers placing sell now at the same time, taking the price down with them. But you remember the deal, right? For sellers to sell, there has to be buyers to buy. So on the other side of this candle, there are buyers who are taking their profit, like old buyers taking their profit, or like new traders, again, no strategy, no knowledge, just pressing buy and praying for the price to go up. Those are the kind of buyers who are providing buy orders to these active sellers. Does this clear your confusion? It's not about the number of buyers or number of sellers. It's about who is more active now, who is bringing new money in the market at that moment. That's it. So write it down. A bear candle forms when the price goes down because selling became more aggressive or more urgent for any reason, not because there are more sellers and less buyers. Now, let's move to the most interesting part of the candle, the wicks. I love them. Let me just draw candles real quick. Just a second. See, these sticks that you see, they are known as wicks. They are also called shadows. A wick means that the price went there, the trade happened, but price could not stay there for longer. That means for that candle, the market rejected those prices. The market rejected these prices, and I'll tell you why. As you can see, there are two kind of sticks and both has different meanings. These are known as the upper wicks and these are known as the lower wicks. And upper wick means that buyers tried to push price up. That means they paid prices like 10, 11, 12, 13. But sellers absorbed everything. That means sellers took all those trades and still pushed the price down. So, who do you think is the dominant one here? The sellers, because they are the ones who rejected a higher price. Remember the active sellers. And the size of the candle, the size or the shape or the color of the candle does not matter. The upper wicks are always your selling pressure because sellers are the one who are pressuring the market to go down with their active money. Also, hey, do not start taking trades now just because you know that these upper wicks means that sellers want the price to go down. It is just showing seller's intention for that price, and that is not enough for you to start placing orders, right? Save your save your precious money, capital. Now the lower wicks are the opposite. Uh, in lower wicks, sellers are the ones who are pressuring the market to go down. But now buyers are the ones who absorbed every offer and they refuse the market to stay lower. They are the ones who push the price up. So that gives us a buying pressure. Again, not not any prediction, just buyer's intention for that price. Okay, let's move to the candle and conclude everything. I think we did 7, 8 points. See, a single candle tells us the story of what happened in that time frame. We are in a 5 minute chart. So this little candle, it tells us what happened in in a 5 minute in 5 minute in 5 minutes at that time, right? If we move to 15-minute chart, that'll show us what happened in 15 minutes. A candle that's taking your price higher are your is your bullish candle. A candle that taking your price lower is your bearish candle, right? A long upper wick means what? Selling pressure. A long lower wick means buying pressure, and vice versa for our short kings. A higher time frame tells us which side dominated the price for longer. For example, if we go to 15 minute, uh, this tells us that buyers were able to dominate for 15 minutes with the body and the wicks both, right? And lastly, the rule. For every buyer, there has to be a seller. And guys, this rule is going to help you a lot with the concepts. So I hope you understood how a candle is formed, how a candle moves the price, how rejection works. I'll give you something to practice. Go to TradingView, open any chart, and just watch. Just watch how a bull or a bear candle forms and how it moves the price. Hey, no analysis, no indicators, no stress, just observe. That's it. That's it for the day, right? Until then, he's just signing out.